And so what you get is a stimulus to the economy from this. Now, the government has made an initial estimate of a $13 billion cost, and a lot of that is going to be covered by insurance, as was the case with the Christchurch earthquake. Hello again, everybody. I've decided to take the risk of recording this a couple of days before the Reserve Bank's review of monetary policy on February 23, where they're going to give an update on where they see the economy going. We all expect they're going to increase the official cash rate to some degree. My expectation is, as the markets are expecting, an increase of 0.5%. These are very uncertain times we live in. We're all trying to figure out what does it mean that the Ukraine war is still going on, what's happening with China-US relations there, is inflation really falling in New Zealand? But the key issue for the moment is that out there in the wider New Zealand economy, some people have adopted the view that because of the terrible events we've seen with the flooding in Auckland and Northland and the cyclone coming through and decimating parts of Hawke's Bay, Gisborne, that surely the Reserve Bank must ease monetary policy to help drive extra growth in the economy. Well, let me try and help you towards your own thinking on this. In the short term, some economic activity is taken out of action. So some stuff that was going to be done is not going to be done. Some people who had jobs are not going to have jobs, harvesting on the farms, those sort of things in the very near future. Supply chains are disrupted. Somebody in one part of the country that's getting inputs into their manufacturing process from a separate factory in Napier, for instance, maybe they're not going to get those goods for a while. So in the very short term, you get a negative economic impact. But think about what you're seeing out there with regard to the impact on inflation, that there will be upward pressure on the price of fresh fruit and veggies, as always happens when you get a weather event which destroys crops, near harvesting, early days of growing, or whatever. So first of all, you get an inflationary impact coming along from that. But secondly, we're going to get another inflationary impact coming along because there is a lot of rebuilding to be done. There is a massive amount of work to be done initially repairing the infrastructure in these locations, getting rid of silt, etc., reopening of the roads, demolishing houses, as we saw in Christchurch after the earthquake in February 2011, rebuilding of so many facilities, the houses, etc., over an extended period of time. There's temporary accommodation needs to be sorted out for people, so maybe some people will relocate to a different part of the country, as happened with the Christchurch earthquake. Many people went to Ashburton, further north, etc., and placed upward pressure on property prices in those locations and on their rents as well. And so what you get is a stimulus to the economy from this. Now, the government has made an initial estimate of a $13 billion cost, and a lot of that is going to be covered by insurance, as was the case with the Christchurch earthquake. That cost is going to be spread out over a long period of time. Some people are thinking, well, we need the economy stimulated, or we need tax increases to pay for this. No. Everyone in New Zealand knows that in New Zealand we can get bad weather events, we do get bad earthquake events, and government accounts are kept in pretty good shape ever since the early 1990s in order to handle these things when they do come along. The New Zealand government accounts are in extremely good shape. I've mentioned this before here a number of months ago. There is not a single credit rating agency or fund manager overseas expressing any concern about the New Zealand government accounts, either the annual operating balance there or the total level of debt, which is massively lower than in other countries as a proportion of the size of one's economy. So yes, the government has easy, massive capacity to handle the cost of rebuilding there. It's a question of getting things done relatively quickly to allow people to get back on with their lives. But the upshot of all this is that on February 23, the Reserve Bank will give a lot more detail to this because they have to. It's their job in conjunction with Treasury, but I would be surprised if they do not increase interest rates by the 0.75%, meaning if they only go 0.25 or say we're going to hold steady for a moment, my commentary will be, oh, I'm surprised. this is a sort of thing that can happen because, as many of us have seen in the past, picking what happens with monetary policy on a 2-month to 2-month basis can be a relatively fraught exercise. The positive news, of course, if you haven't caught up with it already, fixed interest rates seem like they've already peaked out there. We've had cuts for fixed rates of 2 years and beyond, and we've got some of the major lenders out there already starting to discount the 1 to 2 year fixed interest rates relatively heavily underneath the boards, not advertised there, but sort of behind the scenes. So we live through interesting times. Good luck to everybody out there, especially if you are in one of the affected regions. All the best.